brand new day, brand new week, brand new month. It's a good start. We are certainly above 19,200 and it's a breadth which is looking meaningfully positive. So let's take the Bajaj Auto dispatch numbers out from the ticker and then we'll capture some other gainers and losers as well. Wipro, HDFC Bank, Tata Motors, Adani Enterprises, all of them are off to a good start. You got, I want to mark some stocks in news, UltraTech and then GHCL. There are two stocks which are in news, and now it's going to be HDFC Bank. It's not going to be HDFC Limited. HDFC Bank, and where that stock is moving. It's not HDFC Limited. How interesting is that? 15 rupees higher for HDFC Bank. It is now the fourth largest bank in the world, the largest bank in India, and the CEO Shashi Jagdishan is talking about doubling the bank in 4 years. Wow. 1717. The stock which has underperformed for many months after the merger was announced, could it really regain the momentum and could it really take markets higher? Let's see.
Yeah, that's one stock which is actually holding up in trade. Let's revisit what the report card from Motown is like. Bajaj Auto, the yearly numbers as well fell short of market expectations and they've seen a dip come by of almost 1.5%. Bajaj Auto currently down by about 0.5%. Hero MotoCorp, Escorts, they've all disappointed, as has Maruti too. Hero MotoCorp starts off down 0.6%. Escorts though is holding up 1% as we speak right now. And Maruti will just come up for you on your screens. There too, the June sales have come in below the estimates at about 1.59 lakh units for the month gone by. 9,700 is where you're currently at for Maruti as we speak right now. Tata Motors, good numbers coming in there, so let's see what that stock is up to. L&T Finance, we were just flagging off this stock. They've appointed Sudipta Roy as the MD and CEO with effect from Jan 24, 2024. L&T Finance Holdings gaps up 2.6% in the green as we speak right now. UltraTech Cement, the dispatch numbers also have come. The sales value volumes have come in higher by about 20%. So let's check in on that stock. 2%, that's a smart start for UltraTech Cement. Coal India as well, the production for the month gone by has come in higher by nearly 12.5%. The coal offtake as well has risen. These are a couple of stocks which are in focus. And Gujarat Gas, we were just flagging off that earlier in the show. The government, remember, has hiked the import duty on propane for commercial use to now 19.25% from the earlier 2.7%. Gujarat Gas has gapped up 4.25% as we speak right now. AB Capital, they've completed that 1,750 crore rupees QIP, which we reported about earlier last week. There's been BlackRock, there's been Adia, they've all been amongst the investors. AB Capital will just come up for you on your screens next. Mazgaon Dock, they've bagged an order from the Defence Ministry worth about almost 2,700 odd crore rupees. So Mazgaon as well as the other stock which is in focus. And NCC too, they've bagged new orders worth about 2,055 crore rupees in the month of June. So that's a robust order book that we are talking about. NCC 123 is where that stock is. Kunal, what are the first trades that you're punching in?
Well, looks attractive as a setup for the markets, opening many large cap names firing up. So all in all looks attractive. Tata Motors is something which I would be bullish on from current levels. I think the stock has hit the 600 mark. So looks attractive, and I think the all-time high levels for Tata Motors is also very, very close by. So that's a stock which I'd look to buy.
All right, let's find out what Naresh is punching in as his first trade. Naresh, taking a look at the screen, the fact that we're holding out by 0.5% across the board, the broader markets as well are outperforming. What's your first take?
So country like Bandhan Bank, which has underperformed, can see a catch up at 240.43. Looks interesting, having a target price of 275 here. So looks like a good buy at current levels.
Okay. All right. Let's look at some AMC stocks. Is there a follow-up there? Birla, HDFC, Nippon and UTI. No real large powerful follow-up buying is there in any of the AMC stocks. Whether it is Aditya Birla, whether it is HDFC AMC, whether it is UTI AMC, and for that matter Nippon. Naresh, I mean, this was like the go-to space. Big moves, 15-20% moves in AMCs. And they've seen this move after a gap of many months. But Over the weekend, looks like the excitement and euphoria has completely died away because after such a strong breakout also, there is very little follow-up buying.
It was an event-based move, and generally what we see is the next day there is some bit of a fade-off. So out here, a fade-off could be an opportunity, at least in Nippon Life, if it gets closer to 270, 75 levels. So you want to wait for that fade-off to happen. The event move tends to fizzle out for the next couple of sessions, and if that comes to 270, 75, it would be a good entry point.
Kunal, the same point. I mean, there's no follow-up buying. It was a good breakout. And with such a good breakout on volumes, you expect the follow buying should be there.
Yeah, but the stocks have already rallied more than 15 to 20% prior. HDFC, AMC, Nippon AMC, these stocks have done reasonably well. So I think my sense is post the kind of news flow and the sharp spike, these stocks are seeing a mild bit of a retracement. But what these kind of breakouts they actually do is they catapult the stock to a new range or a new a buying zone altogether, where the supports move up significantly higher and the targets on the upside move significantly higher. So the pace of the rally would slow down significantly for the stock, but the uptrend would still continue.
Cement, that's your big sector this morning. UltraTech Cement, by the way, is one of the top gainers, holding up 2.6% as we speak. M&M as well, not looking bad, a 2% uptick coming in there as well. And of course, from within the broader end of the market, it's Gujarat Gas all the way, holding up 4.5% as we speak. IDFC, Ashok Leyland being the other buzzers in trade. But now that the Sensex has scaled life highs along with the Nifty, its journey towards that 1 lakh mark gets closer. When will we hit that mark? What are going to be the factors that are going to lead that? Hear it out from Atul Suri, Vijay Kedia, as well as Sameer Arora.
I haven't done the maths, but why not? Really, why not? It's just basic compounding. It's going to get there, yeah. You know, having been in the market for 30 years, I saw the Sensex at around 1,000. So that's like what you're talking about is a 50, 55, 60% move. So I'd see that there's no reason.
Because I don't invest in any Nifty stock or any Sensex stocks and all. So when I talk about Sensex, that means I'm talking indirectly, I'm talking about my portfolio. So whether index doubles from here or not, that is a different issue. But I expect that this mid caps where I am investing, in the general mid cap category, good stocks should double or triple in next 2-3 years time. And so far index is concerned, I think that index is a counting of 21 is happening index 21,000, 42,000, 63,000. And I think that next stop should be 84,000 in 2 years from now. And of course, 100,000 is just a destination, I think, and miles to go for index.
So for that, my simple thumb rule is compound at about 13-14% and see whether 1.14 to the power of 5 into 66,000, does it become 1 lakh or no? So plus minus, it would be there. Because broadly speaking, if I look at it over any reasonably longer period, the returns have been in this range. So, it doesn't need too much of rocket science. That's why I tweet saying you want 2 lakhs, you just extend the number of years. Because broadly speaking, this number doesn't come only from the fact that historically this has been the range over last, I saw it over 3 or 4 periods, which is 5-7 years. And then I think I did 14 odd years and then some 20 years and then my own track, my career, which is about 26, 27 years. And broadly over every period, it is in this range. But this range is not just coming by looking at historical numbers, but by the fact that Indian GDP in rupee terms grows about 11-12%, and then you can add 1 or 2 more percent for the fact that corporate sector might be doing better than the rest of the economy, or you might be doing it from an equity risk premium point of view that equity returns are normally 5 to 6% more than the fixed income 10-year type return of the same country's government bond. These are all worldwide things. And also broadly, we feel that for a large part of the corporate sector, the earnings growth for normal, once they become a little, this thing is in the range of 12, 13, 10, 15%. And then some companies grow at 20, 30% for some periods of time. So from all angles, it looks that is the thing. So you just multiply and see, but I would think it would reach somewhere there.
Now, that to me is very reasonable. Yeah, because I would be disappointed if the Sensex had not touched 100,000 5 years from now.
I'm absolutely certain it will reach 1 lakh. Now, whether it happens in 4 years or 6 years, frankly, is really a meaningless debate. But looking at the nominal GDP growth rate, which we are looking, you can safely say we can grow between say 12 and 14%, maybe 10 and 14%. You will approximate that number, and if you compound it at that, so in 4 years, roughly from 60,000, you add another, say it comes to approximately 1 lakh in 4 years. I mean, it's not a reach to see 1 lakh, just at the simple compounding of the nominal GDP rate. I think it's a given.
We had a bit of an audio problem, so let's start with why markets are up, and how would you rate the margin of safety, given that right now it is more about liquidity and global strength?
So, good morning, Nikunj, and sorry for that audio trouble. But I think, see, we are at a new all-time high, but mood is not at all euphoric around. It's one of optimism. One cannot deny that. But at the same time, somebody who has lived through 2003, 2008 cycle cannot forget the kind of euphoric feeling was there. For 3, 4, 5 continuous years, market keeps giving you double-digit return and keeps building on that. It is then you start making decisions based on the returns that you've made in the market, based on your M2M. You start and go make car purchases, home purchases, and all that. All those kind of things are yet to pan out. So I think this rally is good to continue from here as well. It's based in solid fundamentals, and we have not yet moved away too much from those fundamentals.
So Ravi, it's important for us to understand that what is the definition of euphoria and what is the definition of participation. How do you discuss and how do you judge that?
No, so just to give you a sense and perspective, FIIs at peak have owned about 25% of India's market. And just a month back, their ownership had dropped to almost 17%. That tells you, right? 17% barring the global financial crisis is the lowest that they have owned since FIIs were allowed to participate in Indian market. So where is the over ownership on the FPIs? One can say that, okay, everybody is bullish on financials, but at the same time, financials, the NPA cycle has just turned around. The growth cycle, the credit growth cycle has just picked up. There was some amount of margin pressure due to increase in rates, but even now, RBI has paused on the rates as well. So the fundamentals are good to continue from here. The overall capex cycle is picking up now. I think it's too soon to worry about any kind of over ownership or overvaluation or overheating of the market. I think these things come after a sustained period of rise in the market. And honestly, our last 5-year returns are probably like in 10-11% kind of CAGR. That is not something that you would say is euphoric by any measure.
I'm going to put this data out just for the benefit of our viewers. Ravi referred to this data. We've looked at markets from COVID, the institutional activity from COVID. Now hear me out. From COVID, domestic institutional investors have been net buyers to the tune of 4 lakh crore. But foreign institutional investors have been net sellers to the tune of about 2.8 lakh crore. So net, post-COVID, India may have emerged as the destination in terms of resilience, growth, China +1, stable democracy, coming out of COVID clean, managing inflation the right way. But frankly, foreign institutional investors, the point what Ravi alluded to, they've turned their back towards India. So Ravi, it's a simple maths. What if the selling only normalizes? 50% of that also comes back. That means 1 to 1.5 lakh crore could easily come back.
I would presume that we are going to get double of whatever was sold. Forget half of it coming back. In the first month itself, which was the May month, we got $5 billion. And again, in the month of June, I guess the number is somewhere closer to that $5 billion. We have had almost $8 billion plus of selling by private equity players, promoters. So many block deals have happened and everything got absorbed. And none of those deals happened at any kind of a discount. They were at 1-2% kind of a discount. So no doubt there was supply in the last 1 month, but obviously the flows coming into the equity markets were far stronger than the supply coming in. So that tells you that there is an appetite. The lack of discount tells you that it's not like promoters are exiting at the peak of the market or any such thing. I think it's a misnomer. I think people are trying to, of course, readjust their portfolio, and maybe it is either deleveraging itself, or maybe the trust in the market is not there, which is what is leading to some of the players exiting, or some people have other compulsions like their fund is coming to an end, so take the exit while it is available. But honestly, I think these have been fair deals from the point of view of the buyer as well. They will make money on that, and $8 billion is not a small amount. Indian market now provides the depth like it has never provided. In the global financial crisis, $15-16 billion of selling led to a 60% fall. A $40 billion selling in the year 21 led to 15-17% fall. Everybody is getting an exit, PE player to promoters. Now, what is that doing is that is actually popping up on most FPI's radar as a market that has the depth. We have the domestic institutional capital pool available to absorb the kind of outflows that happened in FPI. Another thing, India has always been the top performing market in the 3, 5, 10-year period in the top 3. So we are providing returns. We have also provided opportunity to generate alpha. Most number of multi-baggers have come from Indian market. So we provide returns, we provide alpha, and we provide depth also. So this is a market now, in my opinion, after US, the number 2 market in the world where people will want to have an exposure. And even today, the sovereign wealth funds, long only pension fund, endowment fund, their exposure is in their scheme of things is barely less than 1%. So even if they were to match the MSCI index, there's a huge scope for a lot of money to come in. And now India has the ability to absorb those kind of flows. So I actually tweeted a few days back that get ready for $100 billion inflow. And I think that's going to happen. I don't know whether it will happen this year, next year, but for sure we are going to have $100 billion kind of an inflow.
So Ravi, why is that this time the set of stocks which historically have gone higher are not participating? Reliance, Infosys, it's Tata Motors and HDFC. If flows are coming back, would they be hunting different opportunities, different sectors? Because that's what happens, they say in the market. I mean, courses remain the same, horses they change.
No, so see, seasonality to seasonality, water will find its own level and water will flow to where the opportunity lies at that point of time. Again, nothing against a particular company or anything, but whichever my personal area where I believe that the opportunity is essentially domestic focused sectors. We are not so bullish on the global markets. We are not so bullish on the global export opportunity, and we are more bullish on domestic opportunity. So financials, auto ancillaries, then manufacturing, energy transition related plays, discretionary consumption, which currently is undergoing a kind of a soft phase. But these are the areas to focus on with the next 5 years point of view, where maximum alpha can be generated, because the profit pools are kind of still very small in conjunction with the opportunity that is coming up.
Okay. Ravi, there's an extraordinary, I won't say event, but a big merger, HDFC Limited and HDFC Bank, which will have ramifications for everybody. Markets, flows, for the banking sector per se, because the balance sheet size is so large. It's now the 4th largest entity in the world. What could be the implications of this on flows, on markets and the sector per se?
So it cannot be anything but positive. Overall, we finally have a company, now more than one company is there, which can be a global leader. When Apple market cap is hitting $3 trillion, and the largest company out of India is roughly about $140-150 billion, that tells you the kind of size difference there is. See, India is a small cap in the world. We are roughly about $3.5 trillion in a world market cap of more than $105-110 trillion. So at 3% of world's GDP and 3% of the world market cap, we are a small cap. But now we are showing the ability in every which way. Markets are coming of age. The companies within India are also coming of size and age, where people who want to take $200, $300, $500 million, maybe $1 billion kind of a stake, that is also possible. So I think over a longer term period, this behemoth will become a must own for most of the large global funds. So, and it is, I mean, I'm very glad this is a group that you can, hold at the highest in terms of corporate governance standard. So absolutely a draw for overall capital into India. And I think that's the beacon of Indian market.
Okay, I'm going to put this quote out of Mr. Sashi Jagdishan, and this is something which he's written to employees and shareholders. We could be creating a new HDFC bank every 4 years. Now, Ravi, on a balance sheet size of it's the largest combined balance sheet size now. They are looking at doubling in the next 4 years. For HDFC Bank to do that, do you think it is going to be a pure market share gain, or it really could be a pure growth in India which they will capitalize on? When 4 years double on that balance sheet size is incredible.
No, but those are the kind of numbers. I mean, if India is going from $3.5 trillion to $5 trillion economy, a company like HDFC Bank can definitely grow. It is not beyond the realm of possibility to grow at 18%. And I think that is the beauty of Indian market, where the largest company can also grow its top line at between 15 and 18%, and the bottom line has a possibility to grow higher than 20% also. So, coming to your point, I don't see that as a challenge. Of course, the final delivery will depend on what happens, but it is not that, while most of the profits for the American companies, about 30-40% come from outside of US geography. For Indian companies, mostly it comes from the Indian geography itself. And in India, if India is growing at 10-12% nominal, a bank like HDFC Bank can grow at 18%. So I think it is very much possible, and it will happen. So give or take 6 months or 1 year, but it is going to happen.
So Ravi, what else to your mind right now is in that curve of high growth and attractive valuations? Because that's the perfect combination. Get it right on price and bet on the growth, because future is bright.
So within financials, of course, we've been bullish on the lending companies, but non-lending financials are also at a very interesting juncture. See, India has brought into its fold almost 40% of the unbanked population in the last 5-7 years. There is a move away from hard assets, physical assets like real estate. Real estate and gold form a disproportionate portion of the majority of Indian households. Now there is a move away from it towards financialization. So there a lot more money is going to flow into financial products. So non-lending financial companies are at a very interesting juncture. And whether I say it's the insurance companies or the wealth managers or the capital market related plays, these are all still suffering from the correction of the last 2 years or the last 3-4 years, where there were some regulatory kind of pressure on the company, or there was exceptional pressure on the yields, which was leading to the companies not performing. Now, some of the pressure is relieving, like we saw in the case of AMCs, that, okay, the regulator took a pragmatic view and decided to hold back and take the industry's feedback. So just like that, on the insurance front also, there was an overhang on the a particular company from promoters selling. They took back. So all those overhangs are now going away, which is leading to this space also suddenly becoming very, very attractive. So I would say within the financials, non-lending financials are probably at a slightly better risk reward at this juncture.
So would you be looking at doing the following: reduce the exposure to corporate banks and maybe shift towards AMC or insurance or NBFCs, or you've already done that?
No, we are not looking to reduce the exposure on the lending side, but we are definitely looking to increase the exposure on the non-lending side. So it is not a either or call for us. In fact, we are bullish on both the spaces.
So you'll have to sell something to buy something, because that's how portfolio allocation works, right? So what would you be selling?
We are lucky we are getting inflows, so we don't have to really sell anything. And just like all the money is coming into the market, we are also getting some good flows, and that is leading to us increasing exposure on the non-lending side. But having said that, of course, yeah, we are at the margin. Some of the stocks that have done brilliantly over the last 6-12 months, we are trimming a little bit and creating space for some new bets.
You were bullish on manufacturing, you were bullish on alternate energy, you were bullish on financials. We've discussed financials. What about the other two themes? Especially energy transition. We spoke with you when we had visited the factory of Wari. What is the update there? What is happening in that space? Because now it seems to be the pet theme for everybody.
Yeah, I mean, I think this is a theme that is going to sustain for another 10 years, maybe more also, but let's speak about next 5-10 years. And if that is the case, solar is going to be the backbone. In fact, other places like wind are also doing well within that theme. So, as a investment opportunity, still it has not opened up for the listed market investor. There are still some bets available on the unlisted side. Listed space does not lend itself to investing. So the theme is there. We'll keep our eyes and ears open to see where the opportunity arises. But one has to be constantly focused on this space because the maximum amount of money that is going to be spent in the world in the next 10 years is in the energy transition space. So the opportunities will come. You keep your eyes and ears open.
About manufacturing, and some of the EMS stocks have done rather well. Public information, some of your portfolio companies have done rather well. Do you think this EMS space is now looking like a mini frothy bubble, or it has a long way to go?
So as I mentioned earlier, clearly, there has been some returns have been far sooner and far more than what we had expected. But at the same time, the absolute size of these companies are still very small. See, they are all within the range of 1,500 to 3,000 crore kind of a revenue company and 100 to 200 crore kind of PAT. I feel these companies are going to go to minimum 500 to 1,000 crore kind of a PAT over the next 5-year horizon. So you can have 6 months of underperformance of any such thing, but I don't think it's the time to get out of this space. These companies will become far bigger from here as well. Manufacturing overall is at a cusp where we are witnessing a gush. The order books are filling up very fast. The conversions time is reducing dramatically, and companies are able to pitch to the best against the best in the world and yet win orders. So that tells you that Indian manufacturing is really coming of age. So I will not be in a hurry to call the top of the theme so soon. If you see, I mean, it started in 2014 with chemicals. Chemical manufacturing was the first one to pick up. That theme ran for 7 years, and most of the companies, the worst performing stock in the sector was a 10 bagger. The best performing was probably a 150 bagger. So with that kind of returns in the offing, why would you want to sell just because it has gone 2x 3x in a very short span of time? So we are very bullish on the manufacturing space. Within that electronics manufacturing space, the entire sector will grow at 25% CAGR. Possibly some companies can grow at 35-40% CAGR with inorganic also. So far larger companies are going to be coming out of this space with a far bigger profit numbers. So let's wait and see how this space evolves.
Ravi, interest rates globally have not peaked out. It could be 25, it could be 50, we can debate. But bottom line is that rates have not peaked out. And typically when rates have not peaked out, equity should not do well, growth stocks should not do well. But the reverse is happening. AI stocks, chip stocks, fintech stock, consumer stocks, they've all gone higher when interest rates are likely to go higher. So do you think we've got a reversal in waiting? Because that's what I've learned and understood over the years I've interacted with folks like you.
So the lead indicator towards all the data is pointing to inflation cooling down. In fact, inflation has cooled down, whether in India or whether globally also. Of course, the overall US economy still remains stronger. The jobs market still remains tight, and the consumer optimism is just about beginning to wane. So I believe that Fed is on the wrong side over here by extending the hike. They are essentially engineering a slowdown because the economy is not slowing down on its own. So they will get what they want, which is a slowdown. But at the same time, a mild recession or a slowdown is actually a positive for a country like India because we will be probably one of the few sole growth engines in the world. Even China, the post-COVID rebound in China is not that strong. And also the China plus one, whether it pans out in the manufacturing side or no, but on the capital market side, it's already panning out because funds are looking for an alternate markets to deploy their fund outside of China, and they are so badly burnt in the last 3-4 years that nobody wants to go back to China. So I think China +1 is playing out in the Indian equity markets, and inflation in India has peaked. RBI has paused. So from an Indian markets investor point of view, I think it's far more clear. From US markets point of view, we are not yet clear whether it's 25 or 50 bips, but one can very, very clearly say that after that 50 bips, I think we are done. So not trying to guess when it ends, but at the same time, how does that extra 50 bips matter? There will be pain in the US market for sure. Whether it is in the regional bank it shows up or where it shows up, we don't know. Whether in the consumer spending it shows up, it will show up. And that is precisely why we are not bullish on the export-oriented sectors.
Ravi, at what point in time markets will start getting worried about the next election cycle? I mean, it's a year away, but there would be a time when every second question or every second thought would be centered around that.
So I have a feeling that we are going to go strong into the election because there is a high if you want to bet on the outcome of an election, which I don't recommend, and neither one should bet, but this is the time to bet on it, that election will be positively in favor of the current incumbent government. And at that point of time, probably even if the outcome was not in the favor, then maybe 2 months prior to that. But if it was in favor, then probably post the event is where you will likely see most profit booking.
And before we wrap, Ravi, what we've discussed are B2B businesses, manufacturing, solar. What about owning some of the B2C names, watch companies, car companies, pizza companies, liquor companies? I haven't heard that word from you.
So as I said, currently the discretionary consumption is undergoing a little bit of slowdown, and primarily urban consumption. I believe rural consumption is about to pick up, and urban consumption is also probably going to pick up 6-12 months down the line when the current overstocking is out of the way. I think there was a pent-up demand post-COVID, and that led to a very, very high numbers. Now that is in the base, so we have to wait until that is out of the base, which will be 6, 9, 12 months down the line. Overall, if India's economy is going from $3.5 trillion to $5 trillion, for sure consumption has a big role to play. There will be a consumption J curve, which we have been waiting for since forever, is finally on the anvil, according to me. In the next 5-10 years, we will go from being a $2,500 per capita to $4,000 per capita. And if that were to happen, the kind of money that will come into discretionary spending, and we can already see, some of the sectors where supply has not been created, whether it is the airlines, hotels, that the kind of price increase is just crazy. So we will see this discretionary consumption boom showing up from time to time in various sectors, and it is a secular theme. Use the current slowdown in this space to build upon position.
I'll summarize our today's interaction, and perhaps the most important point for us was the starting point. And if I say that Ravi Dharmesh is of the view that right now markets are not euphoric, there is no bubble, there is no risk of valuations. If a correction occurs, it could be seasonality, it could be liquidity, but fundamentally speaking, if you are long India, do not sell in India just because markets have run up. Can I summarize our today's interaction?
I would say absolutely. Just a little bit of caveat, a 5% correction cannot be ruled out at any point of time, 5-10%, but that does not mean that the trend is changing.
Really fantastic to have you back. Thank you for joining us. And for a change, we've not discussed pharma. We'll keep that for the next time. All right, let's take a break. Are we taking a break? No, we're not taking a break.
We are talking about markets. By the way, look at the Nifty right now, 19,300. So we're clocking almost 100 odd point lap, almost on a daily basis. 19,328 is where we're currently at for the Nifty spot. And the futures now already are just 22 points shy of that 19,400 print. Who knows? Soon enough, we could make it to that 20,000 mark on the Nifty as well. But let's talk about what's going to take the markets higher, the individual companies which have been doing all that well. And let me welcome on board one such management, Ashish Gaikwad, the MD at Honeywell Automation India, joins in on the show right now. Ashish, hi, morning. Great to have you today on ET Now. Ashish, you're aiming to double your India business to $1 billion within the next 5 years, with an annual growth ranging between 15 to 18%. What levers do you see for this kind of growth number?
Well, good morning and thanks for having me here right now. First of all, I must say that we have two different businesses that I'm representing. One, which is the Honeywell Automation India Limited, the listed company that everyone sees. And then the other part, which is Honeywell, which has many other businesses also slightly outside of Honeywell Automation, right? So when you're talking about $1 billion business, we already are clocking those kinds of revenues in India for the entire Honeywell, right? And so our ambition is to typically grow about 2 to 2.5 times of that of a GDP growth. So we do want to pick up share when the economy is doing well. And for India, as you can see, most people are quite bullish about it. And there are all the sectors that we serve. Take the civil aviation, talk about the buildings automation, or the process automation, or infrastructure, etc. All of them we see as the vehicles for us to grow.
Sure. Exactly what you said, that this is not just Honeywell Automation, but two segments of your business. I want to talk about the other one, because despite large investments in infrastructure, logistics, capex, your execution rate still seems to be lagging. I mean, I'm just looking at some numbers, and revenue for FY 19-23 has been about 3,175 to now 3443 crore rupees respectively. When do you see a meaningful pickup in your execution and revenues?
Well, I guess we have shown about 17% revenue growth year over year in FY23. And our order pickup is also in good double digits. Now, one thing we must realize is we are in a long cycle business, meaning our projects turn around 12 to 18 months. So when we pick up orders, we turn them over a period of more than a year sometimes. So that is one. Secondly, while there is growth, we at Honeywell always are very careful about the quality of orders. So we will be careful in picking and choosing which orders we would take for making sure that they are profitable and they are sustainable.
Morning. I wanted to also understand as to, some of the challenges when it comes to the semiconductor chip shortage. Is that now behind us? And by when do you expect some of these challenges to tide over, and thereby how will that help the business?
Sure. I think if you take about 12 to 18 months, scenario when pandemic hit us and then some other challenges in the market, I think there was a bit of a chaos at that point in time. From that to now, there has been a very, very structured improvement in the supply chain, especially in the chipsets. And all companies, and we included, we have now shifted to new designs. We've changed our chipsets that we used to use, maybe 18 months ago. And therefore, everybody has learned to tackle this problem. And we are not still out of the woods because the capacities for chip making are still getting built. However, I think we are far, far better right now, and our delivery cycles have improved quite a lot. So I'm very, very optimistic that in about a quarter or two, this should be behind us.
Sounding bullish, things are looking up. It's never been this great for the manufacturing sector. Yet for Honeywell, the margins are below historic average. Why?
You're talking about the Honeywell Automation India Limited, and we are a mid-teens, margin company for the reasons of the business, the mix that we have, and it's a function of mix as well. And we believe that while we are in the mid-teens, when you compare similar companies who are having a similar portfolio and a similar type of mix, we will be in the first quartile there.
Incremental business do you see could come to a firm like yours because of the China plus one compulsion? One is need and second is urgency.
Yeah, certainly. I think we just don't want to just jump on the bandwagon of China plus one. We will always weigh where it is wise globally to invest. And we believe today India is a place where we have a strong confidence. Now, we have always been manufacturing in India. This is not the fashion of or the flavor of the recent season. We have three large factories in India, and we manufacture not only for the Indian market, but also for the regions that we serve from here in India. We can always think of increasing the capacities, and that plan, as we speak, we are deliberating within our teams.
The ratios I always look at when I judge the health of a company is ROCE. For me, that's the benchmark of understanding any company. Your ROC in March 2020 was 35% and March 2023 was 19%. Why has return on capital gone down?
Well, I think you know the reasons, the ups and downs that we have gone through in the last 3 years or so, pandemic included, inflation, supply chain challenges, and some of the others. I think we are tackling those, and I'm sure that in a long cycle business like ours, as we take the right actions and look at where we need to induce the capital, we will start slowly changing that profile as well.
About 3 years out, I'm not getting into an guidance here, but directionally, let's understand it. Do you see a marked improvement in your ROCE? Could it go back to your average? Let's say what you had in March 2018, in March 2019, because you had numbers which were north of 30. 30 has become 19. Could it go back to the glory days?
Well, again, I would not like to speculate exactly like what you said. What I can do and my team can do is to take the right decisions, take advantage of the current environment that we see and the growth that we anticipate, and continue to grow at a healthy double-digit number, probably 2 times or more of the GDP. And I think that's what will drive the rest of the parameters.
Ashish, I have 2 questions for you. And, first I want to talk about what are your plans when it comes to the defense sector? Would you be looking at tying up with other PSUs for avionics, for electronics, or the missile sector?
Well, again, so this is a portfolio that is not included in Honeywell Automation India Limited. So I just want to make sure for your viewers that they are clear. The short answer to your question is absolutely. Defense, we see as an area for Honeywell to engage. We have very strong technologies where we are already working with companies like the Hindustan Aeronautics Limited and some of the other private sector companies as well. And as this particular sector picks up and really gets into more and more products, we in Honeywell are very keen to engage with all those programs.
Within the listed entity, what is the status on your current order book? What are the order inflows that you're likely to see this fiscal? And which segment do you think is going to top growth for you? And, also if you could throw some color on new opportunities like, the 5G rollout, EVs and other new areas.
Okay, that's a loaded question. I'll take some time to explain that to you. So first of all, for Honeywell Automation India Limited, if you see the last year's performance, it's about 12+% growth year over year. And we will continue to have the similar double-digit growth as we anticipate and see the pipeline. And the sectors that we see are both the core and the non-core sectors for us. When I say core sectors for us in the field of automation, this is about the refineries, petrochemical complexes, chemical plants, pharmaceuticals, pulp and paper, etc., etc. I think that entire industry is putting new capacities, modernizing, bringing in digital solutions, and therefore wanting to have cybersecurity around it. So all of that is a sweet spot for us at Honeywell Automation India. The non-core or the emerging sectors where we have engaged is the sectors like new energy and the gigafactories, right? And so that's another new area where we have started a strong start, where people want to put manufacturing capacities for the batteries or electrolyzers or fuel cells. And also when we are talking about the increase in renewables like the solar plants, they need to be augmented with what is called as the battery energy storage system, which is juxtaposed to the actual plant, so that at night time when you need energy and the energy demand is peaking, you can supply through the battery. So again, that is an area which is of great interest to Honeywell. I think that is, so those are the sectors which we will be focusing on, not to sort of miss out on the new stuff coming up on the hydrogen, right? So we are again engaged very much on the automation part of hydrogen and the gas distribution, et cetera, et cetera. Coming to the second part of your question, the industrial Internet of Things, the IIoT you mentioned, the 5G, absolutely. You know, if I have to mention to you which are the two mega trends that we at Honeywell believe we will be focusing on the most, it will be on the digitalization of the industries that we serve and the sustainability portfolio that we have, which is very uniquely positioning us for the next 10, maybe 20 years, right? So as a part of digitalization, IIoT, 5G, sensors, you know, giving solutions which are cloud-based, which can go across the enterprise, is a very much of a focus as far as Honeywell in India is concerned. I can just very quickly give you two examples. You must have seen so many companies coming up with the pledges that they want to be net zero by 2035 or 2050 or whatever. But the difficulty is, how do you measure where you are right now? What's your current emission position? And so therefore, using the IIoT and 5G technologies that we have, we can currently benchmark their emissions and then also chart out a journey towards their net zero goal, such that, you know, they can track the emissions using these sensors and the IIoT technology on a weekly, monthly, and yearly basis. And it can also become a tool for reporting to the authorities in the country, right? So just as an example, you know, how this whole thing is going to be getting an impetus with the net zero goals.
Right, Ashish, great to have you today on ET Now. Thank you so much for taking the time out and joining in.
Thank you.
Okay, that's the word coming in from Honeywell Automation. Good move on the markets. Steady shape, 127 points higher for the Nifty futures. 22 points away from now 19,400 on Nifty futures. Spot Nifty already at 19,300. We continue to clock newer peaks on a daily basis in blue chartered territory. HDFC Bank, those are your top two winners on the index. HDFC Bank is now almost up 3% as we speak, and a 3.5% move coming in for HDFC. We'll take a very quick break. When we come back, continue chatting with a whole host of corporates.